a significant shift is shaking the global financial markets. As of today, market sentiment has dramatically changed, with participants now pricing in a complete 100% probability of a Federal Reserve rate hike in 2026. This shift is fueled by rising U.S. real yields, which are sending shockwaves through currency and equity markets. By the end of this video, you'll gain insights into how this hawkish outlook from the Fed is directly affecting the Japanese yen and what the Bank of Japan's next steps might entail. So, what's driving this shift right now? The surge in U.S. real yields is not just a fleeting moment, it signals a tightening monetary policy outlook for the world's largest economy. Historically, real yields, the interest rate adjusted for inflation, play a crucial role in capital flows. As these yields rise, the dollar strengthens significantly, becoming more appealing compared to other currencies. This trend is putting immense pressure on Asian markets, which are already navigating regional economic changes and trade imbalances. The specifics are compelling. Market data now shows a 100% certainty for a 2026 Fed hike, a sentiment that has intensified as U.S. real yields have surged today. This isn't just a bond market phenomenon, it's impacting other assets, including silver, suggesting a widespread repositioning towards higher rates. Meanwhile, in Japan, government bond term premiums remain high. Bloomberg reports that investors are adopting a cautious approach regarding the BOJ's path to normalization, as the gap between U.S. and Japanese rates is likely to stay wider for a longer period than previously expected. Voices from Tokyo are growing increasingly urgent. Former Bank of Japan board member Noguchi has issued a stark warning. If the central bank continues to avoid rate hikes indefinitely, it risks being labeled the boy who cried wolf. This perception could further accelerate the yen's decline. However, the BOJ's official stance remains one of gradual adjustment, attempting to ease fears of a fiscal crisis by framing the challenge as a matter of steady policy shifts rather than a sudden market panic. Yet, with U.S. rates climbing, the market's demand for a quicker response is testing the BOJ's commitment to gradualism. Financial analysts are honing in on the widening policy gap. While the BOJ signals a slow transition, the market isn't anticipating any immediate fiscal crisis in Japan. Instead, the spotlight is on the upward pressure on the U.S. dollar to Japanese yen pair. Institutional investors are closely monitoring U.S. inflation data and Fed remarks, as any hawkish surprises could further bolster the dollar. Bloomberg notes that the term premium on Japanese bonds is notably high globally, indicating that markets remain apprehensive about the BOJ's long-term direction. The consensus is clear. The yen will likely stay vulnerable as long as the Fed's terminal rate expectations remain elevated. What does all this mean for Japanese equities? For exporters like Toyota, a weaker yen can be beneficial, providing a tailwind for earnings, but the accompanying volatility introduces risks. On the flip side, the high-term premium on Japanese government bonds and the eventual normalization path are critical for financial institutions like MUFG. Typically, banks thrive in a steeper yield curve environment with higher interest rates. Investors are weighing the advantages of a weaker currency against the rising costs of raw materials and the potential for a sudden hawkish pivot from the BOJ to stabilize the yen. The pressure extends beyond Japan. Thailand recently reported a record trade deficit of 3.4 trillion baht in just 1 month, largely driven by China's aggressive export strategies amid its property slump. This highlights a broader trend. Asian currencies are under significant stress as capital flows towards higher-yielding U.S. assets. The U.S. dollar to Japanese yen pair is right in the middle of this storm. If U.S. real yields keep climbing, we could witness further yen depreciation, potentially compelling the Ministry of Finance to consider intervention, despite the BOJ's gradualist rhetoric. For individual investors, this environment demands a keen eye. The 100% probability of a Fed hike in 2026 suggests that the narrative of higher for longer for U.S. rates is firmly established. It's wise to refrain from betting on a quick yen recovery until there's a clear shift in U.S. economic indicators. Key metrics to monitor include U.S. inflation reports and any shifts in Fed officials' tones. Also, keep an eye on the BOJ's policy documents. While they seem to indicate stability, the market's pressure on the yen may force a change in strategy sooner than the current gradual plan suggests. Finally, let's explore 3 potential AI-driven scenarios for the upcoming months. In the base scenario, the Fed maintains its hawkish stance, keeping US dollar to Japanese yen under upward pressure while the BOJ makes slow, incremental adjustments. In the bullish scenario for the yen, a sudden drop in US inflation could lead the market to retract the 2026 hike, resulting in a sharp correction in yields and a pullback in the dollar. Conversely, a bearish scenario for the yen would see US real yields rise even further, possibly reaching new multi-year highs, forcing the BOJ into an emergency rate hike to stave off a currency collapse. The catalyst for these scenarios is likely to be the next US CPI data and whether the BOJ can uphold its gradual narrative amid intensifying yen weakness. In summary, first, the market is now fully priced for a 2026 Fed hike. Second, the BOJ is adhering to its gradual approach but faces significant pressure from a weakening yen. Third, regional stresses, such as Thailand's record trade deficit, indicate widespread challenges across Asia. As global yields rise, it's crucial to stay informed on the policy divergence. If you found this analysis helpful, please consider subscribing for more in-depth insights. And let us know in the comments, do you believe the BOJ will be compelled to raise rates sooner than planned?